The Koreans were right that Samsung would deliver strong earnings. Yet on July 7, 2026, the day Samsung revealed its record Q2 earnings, the stock fell about 10%. If you hold Nvidia or any US chip stock, this is directly relevant to you, because the reason it fell is not the one everyone is giving. Everyone blames the leverage ETFs. They are not the main culprit. The price had already floated on hope far above what Samsung actually earns. And hope is the first thing to fall when people start to doubt. The leverage ETFs only made the fall harder. And US chip stocks are priced on that same hope right now. Start with the leverage ETFs. The part everyone gets right is that they made the fall violent. But violent is not the same as cost. First, what a leverage ETF actually does. Think of it like a car that presses the gas pedal harder the faster it is already going. A leverage ETF works the same way. To move 2 times the daily move of a stock, it has to buy more when the price rises. And it has to sell when the price falls, every single day, mostly near the close. Now put that inside the Korean market. Leverage ETFs plus the 2 chip stocks that follow, Samsung and SK Hynix, were more than 70% of all the trading in the market. Let me repeat again, 2 companies and the funds betting on them were most of the whole market. So on June 23, 2026, when the price started to fall, the funds were forced to sell. There were about $6 billion of Samsung and SK Hynix sold that day, just to keep the funds balanced. That was about 14% of everything those 2 stocks traded. The fall forced the selling, and the selling forced more falling, a death spiral. And here is the part that stopped me. The leverage ETFs listed on May 27, 2026. In just over a month, 82% of the people who bought the Samsung fund were already losing money. For the SK Hynix fund, it was more than 90%. Even the regulator did not hide from it. On June 22, 2026, the head of Korea's financial watchdog, Lee Chan-jin, said he wished he had blocked these funds before they launched. He called them the tail wagging the dog, meaning the small funds were now pushing the whole market around. That is the man who approved them, 1 month later saying he wished he has stopped it. So yes, the leverage ETFs made the fall violent. That part is real, but they did not start it. They can push a fall faster and harder, but they cannot decide a fall is coming. Something in the price itself decided that. That is what we look at next. The price was going to fall with or without the leverage ETFs. It fell because of what it was built on. Here is the number nobody put next to the earnings. Before the Q2 earnings guidance, Samsung stock had already gone up about 165% year to date. The good news was in the price before the news even came out. So let me explain something that took me a while to really understand. Earnings are a lagging number. They tell you what already happened last quarter. But a stock price is not about last quarter. It is a bet on what happens next. So when a price is built on hope about the future, even a record past quarter cannot hold it up. I know some of you were taught that strong earnings push a stock up. I believe that too. But look at what happened here. The best earnings in the company's history, and the stock fell. If you think that cannot last for long, let me show you a company you know, Cisco. In March 2000, Cisco was the most valuable company in the world, worth about $569 billion. Then something strange happened. The business kept growing. Revenue went from $19 billion to $22 billion, and the stock fell 88%. It did not reach a new high again for 25 years, not until December 10, 2025. The company grew the whole time. the price still collapsed. Because what held the price up was never the profit, it was the hope. Samsung is the same shape. The record earnings were just proof of the past. The price had already bet on the future that people suddenly doubted. And one day before the earnings guidance, Morgan Stanley warned that the chip run was near its top. This is the real reason, in full. The price did not fall because the funds. It dropped because it has floated far above what the company was actually earning. The funds only made that fall faster and harder. And if you hold Nvidia or any of the chip companies that went up 10x recently, this is the exact question sitting on your own stock. Nvidia passed $5 trillion this year, now sitting at $4.7 trillion. How much of that is this quarter's profit? And how much is hope about the year 2028? If a price is bet on the future, what is a record past quarter really worth to it? That is what took Korea down. The real question for your money is whether the US has the same fuel and the same trigger. The answer is the US has the same pattern. It just does not have the same market. Let me start with the leverage. In 2026, the forced buying and selling from US leverage ETFs hit a record, about $50 billion in a single day. That is 4 times higher than it was just 6 months before. Near the close, it is now one of the biggest forces moving US stocks. So you might be thinking,
Daniel, 4 times leverage volume? Is the market going to crash soon?
But wait, look at the size next to the market. $50 billion sounds huge, but it is only about 1.6% of the trading in the S&P 500 futures. In Korea, the leveraged funds and tool stocks were more than 70% of the whole market. The US market is far deeper. So a Korea-style crash caused by the funds alone is not likely here. But do not relax yet, because it has happened here before, just smaller. On February 5, 2018, a fund that bet against market fear, called XIV, fell from $1.9 billion to $63 million, 97% in a single day. Here is the important part. It did not take the whole market with it. The S&P fell about 4% and then recovered. So the real danger for the US is not the funds crashing the whole market. It is the US has the same fuel Korea had, the individual stocks themselves. The AI and chip stocks are priced on hope, not on this quarter's profit. In one quarter, Micron stock went up about 240%, Intel about 216%. There is a lot of hope sitting in the price. And if a correction ever comes, leverage will make it fast, not gentle. Let me ask you a question. Have you ever been right about a stock and still lost money on it? Tell me below. And if this is useful so far, hit like and subscribe so it reaches the next person trying to make this same call. Here is what I'm watching. Nvidia reports earnings on August 26, 2026. Watch one thing. If Nvidia releases a strong number and the stock still falls, that is the Samsung signal showing up in the US. And be clear about where I stand. I'm still holding. I think the US market is bigger than any single product. But that is the market. Each individual position is a different story. Because even if the market never crashes, there is one place the damage is already certain. I know because it happened to me. Sometime in early 2023, I bought an inverse ETF called SQQQ. It is a 3x leverage ETF that move in the opposite direction of the Nasdaq 100 index, the QQQ. When QQQ goes down, SQQQ goes up by 3 times. So I bought SQQQ betting the market would fall. At first, the market went up, so my SQQQ went down. I understood that I needed to give the market a bit more time to play out in favor of my direction. So I continued to hold it. Then QQQ did fall afterwards. It dropped below the price where I placed my trade. I was happy because I was right about the direction. As I was about to check my app to see how much profit I made from SQQQ, I couldn't believe my eyes. That SQQQ I bought did not come back to my entry price. I was still making a loss. I was confused. How on earth that I was right that QQQ would fall and SQQQ still did not break even? What does that 3x leverage even mean? So let me show you why being right did not pay me. These funds reset every single day, and that daily reset does something strange over time. Say an index falls 20% and then it rises 20% the next day. You would think it is back to even. A normal fund would still be down 4%, but a 2x leverage fund would be down 16%. The loss gets magnified. And that is exactly what happened to SK Hynix. In the week from June 30th to July 6, 2026, SK Hynix fell 16.94%. But one single stock leverage ETF on it dropped 35.66%. That fund now needs to gain about 55.4% just to get back to even. There is a tell for this. These funds do reverse splits over and over because they slowly drift toward zero. SQQQ, the fund I bought, did another one in November 2025. That is the product quietly showing you what it does over time. Warren Buffett said one line that fits this perfectly. When you combine ignorance and leverage, you get some pretty interesting results. The danger was never just the leverage. It was using a tool that resets every day without knowing what that reset does to you. And now look at the pattern across this whole video. The Korean buyers were right about the earnings, and they lost. Cisco investors were right about the business, and they lost. I was right about the direction, and I lost. That is not bad luck 3 times. Some of these products were never built to pay you when you are right. I still believe the market climbs back over time. I even believe the government does not want it falling for too long. But that belief protects the market. It does not protect the product sitting inside your own account. Are you getting this? I went deep on those exact 2 chip stocks, Micron and SK Hynix, in another video. If you want to see how much of their price is real and how much is just hope about the year 2028, click here to watch it now.